Welcome back to another episode of the Hemlane Hustle. Today, we're diving into the world of multifamily investing and the hustle it takes to grow your real estate empire. Today, we're joined by John Casmon, a multifamily real estate investor, syndicator, and the founder of Casmon Capital Group. With over 100 million in multifamily investments under his belt, John's mission is to help others achieve financial freedom through real estate. In this episode, we'll hear how John went from a marketing executive in corporate America, many of you can relate, to an accomplished investor who empowers busy professionals to create passive income. We'll talk about his wins, the challenges he faced, and the lessons that every investor, new or seasoned, can learn from. John, welcome to the show.
Dana, thank you for having me. Great to be here today.
Great. Well, I know a lot of our listeners are in the corporate world, and you made that transition from a successful career in marketing to real estate investing. What was that light bulb moment, and when did you actually make that leap?
Yeah, so appreciate you bringing that up, right? So, like many of your listeners, I was in corporate America for 15 years. I enjoyed my job. I know a lot of people hate their job
Mhm.
and can't wait to leave. I loved what I was doing. I was going to the Super Bowl and hanging out with celebrities and launching vehicles and TV campaigns. So, I really enjoyed what I was doing. However, I didn't control my time and I didn't control my own future. And a couple of things happened. First, I was working at GM, back when the economic downturn first happened. And I watched a lot of my peers get let go. And that led me to say, you know what? I need to do something to insulate myself from this. So I started investing in real estate. It took some time, but my wife and I, we moved to Chicago. We bought a two-unit building. So we had this duplex. And I was just this guy with a duplex, right? So I had this one property, lived in one unit, rented out the other. And then that was working pretty well. So we bought a three-unit building. So that was going really well. Here I am now, a real estate investor with cash flow coming in and tenants paying rent. And I'm like, this is nice. I can do more of this, right? So I end up going out and I buy an 8-unit building. I wanted to go to commercial. I wanted to scale. I wanted to see if this could be the thing that I ended up doing. Right around the time I bought that 8-unit building, the agency I was working with ended up going into bankruptcy. So here I am. By the way, I just had my second child. I had depleted all my savings to invest in this 8-unit building. So I've got no money in the bank account, and my job is getting ready to go away. So I went through a little bit of depression and a lot of panic and stepped back. And I realized that what I was doing strategically wasn't working and didn't set me up for the long haul. So in that moment, I knew real estate was working, but how I was doing real estate wasn't really working as effectively as I wanted. So that really geared me down a different path, ultimately taking me down a path of bringing in a mentor, learning how to raise capital, and going out and ultimately buying larger apartment buildings. And as you mentioned, today we've invested over $140 million worth of apartments, working with everyday professionals to do the same thing.
Yeah. What is, I mean, obviously, I think any entrepreneur can relate to the ups and downs. It sounds like a really bad down that you went through because you have now two children to take care of. And from that perspective, on the financing side and the funding side, can be a bit scary if you've depleted your bank account, to your point, to invest in this real estate. How did you mentally get into the mindset to actually raise capital? And what was that experience like? I think a lot of investors look for track record. I also, in my experience in first raising capital, was a lot of it came from family and friends. And so the question that I might have for you is like, how do you go outside that family and friends network in real estate?
Yeah, it's a great question. So I kind of got forced into raising capital, right? So I mentioned that at that time I had just invested in this 8-unit building and I didn't have any savings. However, I knew real estate was the solution. So ultimately, what I had to do was figure out how do I buy apartments when I don't have money? And I had a great friend that I was talking to. She ran a meetup and she and I we would go to the meetups together, right? She ran the meetup. I would pretty much go every week, so or every month. And through that process, we got to know each other. So I watched her when she had a 3 unit building. She, over maybe a 6 month period, got up to 9 units. And to me, I was so impressed. I'm like, you got 9 units? That's incredible. And I would say maybe a year later, I was just asking, hey, how's business? What are you up to? And she's like, oh, we just, we got 90 units now. 90 units? You had nine a year ago. How in the world do you get to 90?
Yeah, that's
So,
exponential growth.
oh my gosh. So I couldn't shake it, in my mind the whole night. How did you get to 90? And eventually I sent her a message the next day. I said, hey, listen, great seeing you last night. I'd love to learn more how you were able to scale. Would you be open to going to breakfast? And she said, sure. So we go to breakfast. Now, the whole time in my head, the only way someone can go from 9 to 90 units in a 1 year period when when I knew you the whole year before that, you went from 3 to 9. So it's not like you're on this crazy trajectory. In my head, the only logical solution was she inherited a big check and went
Trust
out
fund.
and yeah, her grandfather passed away, trust fund, something white. That was it. That was the only conclusion I could come up with. She told me that she had these investors who had reached out to her and they had been asking to work with her for months. And finally, she said yes. And that was the first time that this was a plausible thing for me. See, the thing is, we all recognize that, hey, you could raise money for deals. Most of us also have this fear that we may not succeed. Well, what happens if I fail with the deal? What happens if no one wants to invest with me? So, most people never really start that process because we've already identified the major hurdles and we're scared to jump over them. When I talked to her, she was hesitant at first as well, but then she started to build out some systems and she felt comfortable with this group and ended up doing it. When I bought that 8 unit, because that was like maybe July, I think I bought that 8 unit building a couple months later. So now I don't have the savings. When my company went into bankruptcy, I immediately went back to that conversation because I'm like, well, if this is the path and that my lack of finances is the thing stopping me from buying more properties, why aren't you going out there and buying or and raising capital? Even still, it wasn't enough to persuade me. The very next month, I met the man who became my mentor. He had raised over $1 million for his first deal. Now today he's raised over $2.5 billion, or he's got $2.5 billion of real estate. But at that time, he was kind of up and coming, and he just happened to be in a city. I had no idea this guy was going to be my mentor when I met up with him. But he was raising capital, and he had a system and a process, and that was the thing that I needed to get over the hump to say, okay, if I can work with someone who has a proven process that's going to help me protect my investors, protect my friends, my family, that's going to make
Yeah.
me more comfortable. So that's the path I went down, was hiring him. And with that system, it made it a little bit easier to start that process.
Walk me through what that process is. And,
Yeah.
and the reason I bring it up is there's almost a chicken and egg problem. In startups, it's like with marketplaces, you have a chicken and egg
Yeah.
of who are you going
Yeah.
to get, the supplier demand side. I think
Yeah.
in real estate investing, I've seen a lot of deals fall through because of the financing. And an investor, especially with interest rates where they are today, and they're not going to like be like, John, here's some money, hold it for 12 months while you find a deal. They're going to be like, great, maybe when you have a deal and you tell me what it is, then I'll invest. And so you have this problem where, but then when you find the deal, maybe the capital falls through. And so
Yeah.
how do you structure a process where that doesn't happen? And the reason I bring it up is I also know a lot of listeners on this show also are just even starting with a small amount of capital, even if it's just one partner to get started with or
Yep.
three. So how do you balance that and know that something's not going to fall through and your reputation won't be at risk on one side or the other?
I love it. That's a great question. So, the first thing is you always need to be raising capital. And what that means is we're not waiting for the deal. We're not
Mhm.
out there hunting, looking for deals, and then you finally found one. Now you're going to figure out who's going to invest. No, you start with raising capital. You start with having conversations. That is the version of this, right? I wrote an article that got into this because people always ask me that question. Should I find a deal first or should I raise capital first and find the investors? Find the investors first. The second reason is, there's this quote that I don't know where, but some gurus came up with this and people always love it. And they say, if you find a great deal, the money will come. That's complete BS. Okay. And the reason
Okay.
it's BS is because you've got to define what a great deal is. A great deal for you may not be a great deal for me, which may not be a great deal for your investors. And if you have no experience and no track record, it doesn't matter. No one's going to believe in you. So the deal sucks, right? It doesn't matter if they don't believe in you. So you've got to find the investors first. You got to find people who believe in you, that understand what you're trying to do, that have the risk tolerance that you have. So when you bring them that opportunity, you already know what they're looking for. Some folks focus on cash flow. Some folks could care less and they just want long term appreciation. Others may want the tax benefits. You don't know what someone's looking for until you start talking to them. So you can't identify what a great deal is for them until you have those discussions. So you start with the conversation so you can get a sense of what people are looking for. It's like basically figuring out what you're going to make for dinner, right? You've got to figure out what's on the shopping list. You got to figure out what ingredients you need, what groceries do you need. You can't just show up with the great meals like, well, I don't like that, right? You got to figure out what they're actually looking for, and then you go out and buy the groceries and make the meal. So that way you come back, you kind of have what people are looking for. There's something that I like to tell people all the time. When it comes to raising capital, it really requires what I call the three C's of capital raising. Okay. And the first C is confidence. Confidence comes from preparation. It doesn't matter if you've raised capital, if you have a track record, you have to be prepared. You can research your market, you can research rates, you can research, your business plan, but you have to know your stuff. The more confident you are, the more likely someone is going to want to do business with you. But that confidence can't be faked. It can't be blind hubris. It has to come from actually being prepared and putting in the work. The second C is credibility. Now, with credibility, this is where that track record comes into play. Now, you may not have a long track record. Maybe you're new to this space. It's okay. You can lean on other people's track records. This is why a mentor, a coach, a partner, that's why those things are so critical. You can also bring in your property manager, your contractor, other folks who are going to help you execute the business plan. People want to see that you can actually do what it is you're telling people you're going to
Mhm.
do. If you don't put together a credible team, no one's going to believe you. So if you don't have that experience, you've got to lean more heavily on the other people around you, but that credibility is absolutely critical. The third C is connections. Now, the mistake people always make is they assume that they have to go with family and friends. And there's nothing wrong with that. However, your family and friends are not your ideal investors, right? We love you, but your uncle Tim may not have the money to invest. He may
Mhm.
not understand real estate at all. So you don't necessarily want to, hedge your bets on getting Uncle Tim to invest with you. Instead, what I would tell you to do is leverage your friends and family to extend your network. Everyone knows somebody. So when you can highlight your credibility, the confidence in what you're doing, and you tell people you're looking to connect with other folks who may have interest, now you open yourself up to those introductions of potential investors. So if you're looking for something to say, I would write this down or put in your text or your notes, but I would send a text message to family and friends and I would write out a list. I actually have a tracker that I can send to you if you want to share it with your audience. We have a tracker
Love that.
and you can put down everyone you know in your network that you will be comfortable reaching out to. And you can send them a short little message and it says, "Hey, Dana, you may or may not know, but I've been in real estate for a little bit of time or I've been investing in real estate. I'm looking to buy an apartment building. Do you know anyone who may have interest in partnering with me on this?" And you can send that message. You didn't ask them anything. You didn't tell them to invest. You didn't try to pitch them on the investment. You're just looking for introductions. So that's the thing that we would do to start to expand our network. If they have interest, they're going to ask you. Most people would be receptive to an introduction. Not everybody's going to respond, but most
Yeah.
people, if they know you, they may say, "Hey, you should talk to Tim. He's been talking about getting into real estate for a while now."
Yeah.
Or, "Hey, my cousin Mike, he just bought a house that he's renting. Maybe you should talk to him." They may not have the best introductions, but you're going to slowly start to build out your network. And that's a great way to start to scale working with friends and family.
Yeah. That's I love it. And I think that extended network plays so well into even like Silicon Valley here and how tech companies are formed. It's usually a couple of people removed, like twice removed from you
Yeah.
that get you there. Talk about financial advisors and are they helpful? So for example, let's just say a friend of a friend says, great, let me talk to my financial advisor to see if I should diversify. I've only been in stocks and bonds. Should I also go into real estate? What do you think is the sentiment with financial advisors on real estate in general as an asset class, and then investing privately and partnering in syndicates and syndicating with the Casmon Capitals of the world?
So, financial advisors are typically not fiduciaries based on what you are looking for. What I mean by that is they're not going to recommend you to invest in alternative assets. Forget my deals or anyone else's, like that doesn't matter.
Yeah.
If you think about a financial advisor's role, typically they work for companies that have stocks or mutual funds that they offer, and their job is to sell those mutual funds or those products. So why would they advise you to invest in something else? Right? There's no upside for them. There's only downside. Typically, they're compensated based on the book of business. So how much assets do you have under management? That's how they get paid. So they're not going to tell you to take, $250,000 and invest it with us. The other thing that's important to understand is the flip side of that. Let's say you invest in something and it doesn't work out. Well, they don't want that responsibility to say, oh, you told me I should invest in this. No, most of them don't understand it. They're not going to advise you. So, as much as we like financial advisors to help us learn about complex theories, in my experience, most of them, 90% or more, know very little about multifamily investing, real estate in general, but definitely in the syndication space. So you do have to get your own education. I would advise you to learn more about the space. Don't just listen to me, listen to other experts in the field, talk to other investors who are doing these deals, because what you will find is multifamily investing and commercial real estate in general, it offers both cash flow advantages, you have appreciation potential, you have depreciation of the assets, which typically leads to these amazing tax benefits. And through all of those things, you also have the leverage of being able to use a loan. So this is kind of almost a five-way advantage that you don't get with other investment vehicles. So that's one of the things that we always love about real estate, specifically multifamily investing. But financial advisors don't fully understand that, and they're usually not incentivized to direct you down that path.
John, I love that comment because I couldn't agree more. I think a lot of folks will only go into stocks and bonds because that's what's easy. That's what their financial advisor tells them to do. And it's not in their incentive at all to go outside of that course. They don't get paid to go outside that course. And if there's any downside risk, they get blamed. If there's upside risk, it's like, yeah, expecting upside. And so I think very similar to like a goalie, it's very defensive in a lot of ways. And
Yeah.
that's why I think doing the work and putting the numbers on there and saying, okay, great. What are all the risks with this deal or investing with this person? What is their track record? What am I looking for? And then putting some capital towards alternative investments makes a ton of sense, but you do need to do that diligence yourself, and no one's going to do it for you. But if you have a coach and an advisor to say, okay, great, take a look at this. What am I missing here? What are additional risks that could happen? I do think it's really important to look at that. And it's actually kind of, in my opinion, a fun weekend activity versus just putting some money in the S&P 500 and seeing where it goes. So I love that. Talk about the struggle with finding the first multifamily deal. So I think investors, once you have your first deal, it's much easier to be like, okay, I got the process down, learned a lot from it. I'm going to improve and slowly improve my process every single time I get a new deal. But talk a little bit about that first struggle and the challenges, and especially in this interest rate environment. Do you think that investors can do now what you did back then? And what are some of those struggles with your first multifamily?
Yeah, it's a great question, right? I mean, obviously, the market has changed drastically from when we started investing over a dozen years ago. I think the first thing with investors is you have to understand what kind of investor you want to be, right? And that starts with your goals. When I was starting out, my main goal was to insulate myself from potential job loss. So I needed investments that had cash flow and could replace my salary income, right?
Hmm.
So as you are investing, take a look at your situation and be honest of what you're looking for. The mistake I see so many people making is they just start buying stuff, right? They buy a house, they buy a rental, they buy a duplex. They're trying to get passive income. They're trying to do all these things, but they haven't really clearly identified their strategy, and they just wake up with a collection of assets and no real plan of, fixing anything or managing it or anything, right? So get clear on that because there are a lot of different strategies. One is actively investing your own portfolio, but you can also invest passively with groups like ours, right? Where we do all the work, find the deals. You can invest passively and put your money to work. When it comes to finding deals, it was definitely a challenge starting out, mainly because you don't know what a deal is, going back to what we talked about, right?
Mm-hmm.
Like when you're new, you think you have a deal, right? But you don't know because you haven't done it enough times, you haven't put in enough reps. The very first property I bought, that 2 unit building, the only reason I got really comfortable is I started with the market. And this is something I push everyone to do. Learn your market, learn the sub markets, learn what's
Mm-hmm.
driving growth. Like what are the key performance indicators in that market that you need to pay attention to? Because once you know the market is great, now you're just shopping for the exact property and the exact investment. So on ours, we had it down to a couple of zip codes and a couple of streets, and I made a list of properties we were looking at. I remember one weekend, about three of the properties went off and went under contract. I added three more properties. The next weekend, four properties went under contract. I'm like, oh, okay, the market's really picking up. We better do something here. And we finally went and put an offer on one. That one actually ended up falling through. We went back to our list and said, okay, this one was still on the list. Why didn't we pick this one the first time? Let's go look at it again. And we ended up buying that property. But we felt really confident because we defined our area, we defined our criteria. We were touring these properties. We were watching them go under contract. We would follow up to learn what did they go under contract for or what did they close for so we could get reassurance of the numbers we were projecting. And this goes back to that confidence I talked about. We had never bought a property before, but we were putting in the reps, we were putting in the work. So I knew based on the sales that I was seeing, this should sell for about 75,000 a door or 85,000 a door. This is getting this kind of rent, this is getting this kind of cap rate. So I knew my numbers pretty well at that point. So when we went to put in the offer, we could do it with a sense of confidence based on what else we had seen in the marketplace. So whether that's 10 years ago or today, the first thing is know your stuff. Talk to the
Yeah.
brokers, talk to the agents, know the numbers, listen to them when they tell you, hey, here's what this is gonna sell for. I'm gonna give your listeners a little trick though. Don't worry about the asking price. Okay. Especially when it comes to commercial real estate. Like they will put whatever for
They
an
want
asking
on
price.
there.
They'll put
Yeah.
and an owner might want $20 million for a 2 unit. You're like, what? But you can't worry about that. Instead, what I would ask, and this is a very seasoned question, so write this down. Do not ask what's the asking price or what's the purchase price. Ask how much do you expect this to trade for? So that is the terminology they use in commercial real estate because properties don't really sell, they trade.
Mm-hmm.
Because in commercial, it's more fluid with the transactions. So when you ask, what do you expect this to trade for? What we're really doing is we're asking the broker, hey, I know they're asking you for 2 million. What do
Yeah.
you think this is going to trade for? And that's when they will typically kind of unarm and say, hey, they're asking two, but what we're seeing in the market, our advice was, 1.6. Okay, now you have a more realistic number of where they
Mm-hmm.
expect this to trade. And it's not saying the seller is going to take 1.6 million, but you at least recognize where the value should be based on the market dynamics. So that's something you always have to pay attention to. The interest rates certainly make it more challenging with the cost of capital, but there's a
Mm-hmm.
saying in real estate that, you buy the property, you date the interest rate. So we can always refinance if you get a great property, but certainly you want to make investments that are going to work based on your investing goals and your business plan.
Yeah. I love that so much about the deal price because often the best investors are going after those ones where the price doesn't make sense to anyone and they win it at a lower price because again, it's an investment, it's a trade. It's hey, I want to really get into this now. Maybe I will go for a much lower price. If it's on a market for a while and there's not a lot of bids, eventually they have to choose something if they're serious about selling. One of the things, John, you and I've spoken about off show is about when to get started. And the reason I want to bring this up is I've seen this mistake in startups as well, um, where someone just quits their day job doesn't really have a plan, and then goes into investing, whether it's in real estate, whether it's building a tech company, without really having fully thought through product market fit, deals, how to raise capital. And so, one thing that I really appreciate and liked that you brought up was timing and when to quit your W 2. Can you give some more advice and lessons learned there?
Yeah, so one, again, you got to be clear on what this is supposed to do for you. If you want to leave your W-2 and go into real estate full time, that's great. There are lots of strategies that you can utilize to do that. However, if you need to have kind of your finances all together, you want to make sure you're making a certain amount of, consistent revenue, passive income each month, then you've got to build up to that. So when I was starting out, we did the 2 unit, the 3 unit, the 8 unit. The company went into bankruptcy, and we had to step back and say, well, how do we continue to grow and scale here? Luckily
Mhm.
for me, I was able to keep working and get that W 2 check, but it really lit a fire to say, you got to really get this real estate thing going better, right? So, one big step that I took was instead of solely focusing on deals that I would find and manage myself, not only did I work on raising capital, but I also partnered with other operators. So the next deal we ended up doing was 192 units. Now we've got scale, we could put in third party management, and we could do this while working, a full-time job
Mhm.
until we could work up to the point where, I could walk away from that environment. So you want to have a plan. The first step is, again, what is your investing strategy? Do you want to invest passively in deals to slowly build up your passive income, to build up your net worth, and then eventually slow down? Or do you need to be more active and find active investment opportunities? So that is the key. A huge mistake I see people make is they want financial freedom. They want to, get all this passive income. So they buy a couple rentals. And what they end up with is a part-time job. And it's not a
Yeah.
very good part-time job at that because the hours suck. Something always breaks when you're on vacation or you're not near the property, right? And it's just a hectic, right? It's just a hassle to work with. So if that's not what you want, if you don't want a part-time job, then you've got to invest with that mindset, which means either putting in property management or putting in solutions that can help you. It may mean investing passively, so someone else is taking care of all of that. You just figure out how much money you want to invest and go. When I was still working my W 2, I had the bright idea to try to do everything at once. So I was going to syndicate, I was going to flip some properties and keep my W 2 job. I got 2 kids, by the way. And those flip projects, they killed me. And I remember one day in particular, I got quoted for one of my rentals, like $700 to paint the unit, which at that time felt like a lot. Today it would be a steal, but back then it felt like a lot. And I said, I'm not gonna do like, no, I'm not gonna pay you. I'll do it myself. Well, I did it on a Saturday morning. This is in July, by the way. So I got to go to Home Depot and get all the supplies. I got to, sand the wall. I got to
Mhm.
wash the wall. I got to prime it. I got to wait for that primer to dry. I got to do a second coat of primer. I got to do the first coat of paint, the second coat of paint. I'm waiting, right? It ends up taking like 6 hours. I'm sitting in this apartment like 6, 7 hours. And I remember sitting on the floor. My wife had FaceTime me with our youngest son at the time, who I think was maybe a toddler. And they're at the park. I think they're at the park or the beach. And I'm sitting in this apartment, literally watching paint dry. And I was like, this is my quote unquote day off, right? From a full time busy professional working marketing,
Yeah.
50 plus hours a week, got these side hustles going to real estate. And my day off, I'm sitting here watching paint dry. My family is out at the beach. I was like, I'm not doing this right. This is not what I signed up for. So that really made me step back and say, okay, I've got to revamp this strategy. And maybe some of those things that were barriers starting out really aren't barriers. And I just need to change my perspective. So that really helped me. And I would just tell your listeners, if you're trying to figure out if you should quit your day job or, just go full time, just have a clear vision of what you're really trying to accomplish. If you really want passive income, then you're going to have to invest passively, which means more patience, which means you need more capital out there working. If you
Mhm.
just want to get out of your job, then great, but you have to make sure you can generate enough income to take care of your family and whatever your living expenses are. So you just kind of need to have some tough conversations with yourself, but take a look at it, but be very clear and intentional about what you are getting into because the worst thing is you want financial freedom and passive income and you really locked yourself into just another job that has crazy hours and very little pay.
Yeah, yeah, definitely. I think that's a good point because you will know when it's the right time to move over. And so I think that's a fantastic point. I want to move on to something different.
Yeah.
You raised millions in capital. What is the most surprising or awkward investor meeting that you've ever had, and what did you learn from it?
Oh man, that's a good question. So I will say I think starting out when you're looking to raise capital, it can be intimidating because what ends up happening is we actually subconsciously put a lot of our self-worth into those initial conversations, right? If I go to you, Dana, and you're one of my, early investors, I haven't done a deal yet, I really care about what you say and what you do,
Hmm.
right? If I pitch a deal to you or I tell you, hey, I'm looking to buy apartments and here's how it works, and are you interested in investing with me? If you say no, I'm going to read a lot into that. I'm going to read Dana thinks I'm stupid, right? Dana doesn't want to invest with me. Dana doesn't think I'm good with money. Dana's like, I can go, and you didn't say any of this, by the way, right? But in
I
my
know.
head,
Yeah, in your
I've
head.
written this entire narrative of why Dana said no to me. And it has nothing to do with that. So it can get awkward initially when we go into those conversations with an expectation that we need that person to invest with us. Starting out, it took me I could say that and I could hear myself, but I didn't fully embrace that. So starting out, some of those conversations were absolutely awkward because I didn't know how to pitch it. I didn't know how to ask people to
Hmm.
invest. I didn't know how to close it. I didn't know when to shut up. So a lot of that was awkward, probably on my part, because you're just learning it, right? And I was pretty good at talking to people, but I had never raised money for anything before. So it was just a little awkward and uncomfortable for me to do that. So I would say most of those early conversations were a little awkward.
I love it. I think you're right. You have to do it and enough, and you will try to understand the reason for a no, because a lot of times a no is a not right now. And what my experience has been is they invest with you later. And so don't make it a definitive no and don't let it get you down. Be curious and screen them. What are you looking for? What types of investments have you done? What cap rate are you looking for? Understand their experience and etc. Because if they decide or your deal is not one for them now, you might have one in the future, or it just may be a timing thing. And so I think
Yeah.
the question of why is really important. Every successful investor has to pivot at some point. I think many pivoted after interest
Yeah.
rates went up. What's one unexpected pivot you've had to make in your investing journey?
Well, I mean, we kind of talked about this a little bit, right? But I was doing my own investments and ultimately having to pivot to work with other investors was a huge
Hmm.
one.
Yeah.
And there are a couple things, right? We talked a little bit about this, but I think the thing that stops people from thinking big and scaling and thinking millions and multi-millions on deals are the fears. And it's everything we talked about. It's really this imposter syndrome that we have within us. And I had heard of other people's money and raising capital for deals, but I didn't think it was right for me. I just didn't. I didn't have the network. Even though I was in corporate America, like those, people in corporate America, they like security. I like working my W-2 job. I put my money in the
Yeah.
401k. Like they're not entrepreneurs and risk takers. They like that security. So I didn't really have the network there. My buddies from home didn't, have money to invest. I didn't come from a family of people who had money to invest. So I just didn't think I could do it. I didn't think it was right for me. On top of that, I was scared I was going to lose somebody's money, right? What if I make a mistake? What if I do something wrong? And those are the fears that stop most people. And what really was important for me was to seek out that mentorship, to find somebody who could help me navigate that, but then also start to break down each one of those obstacles. We can always expand our network, like who you know today doesn't limit you from being out and able to grow and connect with new people, just like Dana and I are doing here, right? So you can always expand your network. You can always learn new things and learn the process and learn from mentors and coaches who have done this process. So that makes it a lot easier. So for me, that pivot came from a mindset shift, when I was faced with very little options. My options was
Mhm.
keep updating this resume and pray you don't get fired, or take control of your future so you're not staring at your young children and trying to explain to them, why daddy doesn't have a job right now. And that's just the reality, unfortunately, is that, whenever you're working for someone else, you don't control it. And it could be for a myriad of reasons, right? It could be for the economy, it could be for politics, it could be ageism.
Mhm.
So a lot of that came into play, and I just wanted to take more control. And I knew I would need to pivot and get comfortable being uncomfortable, raising capital and working with other people. And the last point I'll make on this is what really got me over the top to say, yes, this is what I should do, is when I realized that I was actually helping other people.
Mhm.
Initially, I only looked at it from my own lens. Like, okay, hey, I could buy this $2 million building, but I only have $100,000 or $200,000. We need more money, and I don't have it, so I guess we're not gonna do it, right? So my head was like, okay, well, someone else, if I could find an investor, well, now we got the money to buy this. It wasn't until we actually did our first investment, I raised money on the first deal, that I realized we were truly offering a service to those investors, because they didn't have the time and energy to vet these deals. They didn't spend all that money and
Mhm.
time going to these events, listening to podcasts, reading books, building out their own portfolio. So for them, I was really their conduit to investing. And they knew me, they liked me, they trusted me. So investing with me was the best bet for them. So when you can do that and then deliver and give them great returns and give them a great experience, you're offering a service. So once I realized that I was actually helping other people achieve their financial dreams, now I had a purpose behind raising capital. I'm helping people achieve the financial goals that they have that otherwise they may not do, right? They may just sit there and say, I always wanted to invest, but never did, never took that step. If we could present that opportunity, we have the ability to impact somebody's financial future. So that purpose is really, really huge. And that allowed me to pivot. And I think just shifting that mindset was really big for me.
Yeah, I think that is huge because you need that mission in order to achieve something great. You ready for our lightning round?
Yeah, let's do it.
Worst piece of advice you've ever received?
Oh, just find a great deal. The money will come.
Quote you live by and why?
Tough times don't last. Tough people do.
When are you investing next and where?
We're always looking to invest. I love the Midwest, particularly a 2 hour range from Cincinnati. So Cincy, Columbus, Louisville, those are our target areas.
Awesome. And John, if our listeners want to get a hold of you and learn more about Casmon Capital, investing, syndication, all of that, how do they reach you?
Yeah, so you can always email me, john@casmoncapital.com. But probably better than that is we have a few guides that may be helpful. One is a sample deal package. So if you're interested in multifamily, but don't know what some of these terms mean or need to see like what some of the returns look like, this is a great way just to wrap your head around the concept more. So you can go to casmoncapital.com/sample deal to download that package. And then we also have a new lead or new guide, and it's 7 questions you need to ask before making an investment. So that one is not even live as we're recording this, but it should be live by the time folks are listening to us. So I will make sure we have that available as well.
Awesome. Well, great. Thanks so much, John, for joining today.
Absolutely. Thank you for having me, Dana.